Hello everyone and welcome to my next video in my series about cloud stocks. So today I'm going to present about Crowdstrike and why I think Crowdstrike is such a compelling investment right now. Crowdstrike operates in the cybersecurity space and they mostly focus on avoiding breaches at endpoints, i.e. Devices in the hands of your employees such as laptops. That's what they mainly focus on because there have been so many breaches over the past few years of companies getting massive amounts of data stolen, massive issues with blackmail, and all sorts of compliance issues. And so cybersecurity is a threat, and it's a threat that is rising, and most companies have to have uh, tools in place to prevent intrusion within their IT systems. And it's almost mandatory for most companies. So this has the advantage of being a very recession-resistant business. So what does CrowdStrike do? Well, it's a cybersecurity software that protects you from the invasion or intrusion into your system. But there is one thing that is very different from most softwares that say have regular updates every other day and you have to download and update it. No, CrowdStrike does this from the cloud into the cloud in real time. So it's all a business about AI and network effect. This is all this business here is it's a cloud scale AI. And so as they say, our AI gets smarter as it consumes more data. And they have this proprietary distributed threat graph. A graph is nothing but a neural network. So it's a machine learning system that allows their AI to learn from people on the system. And as more data gets fed into the system from subscriber, the system gets better and then attracts more subscriber and there's more data and it gets better and so on in a loop. And so what are the moats of this type of business? Well, first of all, their technology is patented, so there is a moat on this, but my take on patents is that they tend to be a weak moat because if you get copied, you have to do a lawsuit and it can take years, and at the pace of innovation the time for you to win that lawsuit is too small. So I look at patents as kind of a weak moat. But what I think is a very strong moat for CrowdStrike is this flywheel that they have with their system. They are the company in cybersecurity at endpoint that has the most customer. And since they have the most amount of customers, right, they have the most data. And because they have the most data, they have the best trained AI. And because they have the best trained AI, they can attract even more customers. Customers, data, best product. Customers, data, best products. This is the classic wheel, a flywheel that we get in AI and modern companies, right? The same could be true about Tesla's self-driving system. Why are they the first likely to breach self-driving and to actually succeed at self-driving? That's because we have the most data. And so it doesn't matter if you have the best system. If you don't have the data, you can't compete. So that's why this business is so strong and could really end up being a large business and a standard. The standard because they have the most data and thus they have the best AI that stops threats. And this snowball effect on growth could be really, really huge. And it's a self-reinforcing loop that becomes almost unstoppable. You know, the company that really popularized this concept of the flywheel is Amazon, right? Amazon, when they followed the book Good to Great and followed all about flywheel. That flywheel is really the thing that cements most of AI businesses, and good luck competing with that. So that is a tremendous moat, and even with all of the money in the world, you can't compete with that. It's very, very hard to compete with that because it's all about data. It's not about building a chain of stores or anything. So I'm really confident about this moat, which is why I think it could explain some of their valuation, which CrowdStrike's valuation is a little higher than other growth stocks that I've analyzed, but still compelling right now. So let me look at the business itself. Revenue growth has been very consistent over the years. And it's growing going forward, I believe, at 59%. I mean, it's been growing at 59%, and I don't see it going any lower. It was, in fact, growing faster in the past. I don't see it growing any lower, especially as they capture their total addressable market, which they estimate at 126 billion in 2025. They have captured, not even 2%, not even 2% of that total addressable market, and they are the leader. So I think the growth rate, 59%, is really a floor. I believe they will keep growing. So let me walk through my usual revenue analysis and headwinds, if there are any headwinds. So competition is the only thing that I could see as a headwind for CrowdStrike, because Microsoft Defender for Endpoint is actually ranked as their main competitor by Gartner, and you'd be surprised by that all of the legacy systems, like say McAfee, they're not in that race. Like, they're not even in the same league. The only competition that I see credible for endpoint security is Microsoft. And Microsoft does that with all of its businesses, right? Teams against Slack, Teams against Zoom. Microsoft typically deploys a second grade offering, or like the next best thing, and then ships it to 80 million companies. And companies that do not want the very, very, very best, they'll be very happy with Microsoft's solution. So I do believe that Microsoft will have a big market share in that system for companies who do not take cyber threats as seriously as, for example, banks. Most banks, I think 19 out of 20 major banks in the Fortune 500 are customers of CrowdStrike. Why? Because banks have insane regulation and they have to get the very best. So companies that have to get the very best in terms of cybersecurity and endpoint protection, I think they will go with CrowdStrike. Industries or small industries that may be less prone to cyber attacks, or smaller businesses, they may be likely to go with Microsoft. But Microsoft is nonetheless going to take a little bit of that total addressable market. But this is what I see for competition. Concentration, very little customer concentration on CrowdStrike. They are very diversified. Their net retention, dollar-based retention rate, 120% plus. That is very, very good for a SaaS business. Every year they introduce more products, and customers are adding on those products. So they are providing a compelling product. And is CrowdStrike sensible to macro? Is a recession going to hurt CrowdStrike? Well, I really don't think so, because cyber threats are a priority. That's probably the last thing that companies will cut, especially if you are in one of those sectors that can be so hurt by cybersecurity. And last questions that I ask about any business analysis is the revenue growth healthy? Have they grown by acquisition? Of course, we can see the growth is very smooth, so they haven't had any large acquisition, and so what the companies they've acquired are very small. And lastly, marketing expense, and I find it pretty medium for a cloud style business. It's a little higher than I'd want, but marketing expense sometimes can be seen as an investment in the business, although it's money that you typically don't get back. But if you spend money on marketing and you get a new customer, and that customer stays for you for 10 years, I could see how it's seen as an investment. But nonetheless, they have a typical marketing expense for a SaaS revenue, but it's still higher than I'd like to see for a growth stock. And looking at marketing for a growth stock is very important, because you have a lot of growth stocks that have amazing revenue growth, but you find that revenue growth is mostly because of your marketing spend. And the day they can't spend on marketing anymore, the revenue growth stops. So marketing is really a way to gauge how much of that growth is organic. So let me move on now and look at other things that I look at. So another thing that I look at is near-term bankruptcy risk. Again, CrowdStrike is a pretty new company. Do they have any risk of bankruptcy? Well, no. They're free cash flow positive, $656 million a year, and they have a tremendous amount of cash on the balance sheet. So bankruptcy is not a risk at all. They can comfortably keep growing. Now let me look at the metrics. Gross margin, 74%. That's really, really high, although typical for a SaaS business. But that's really high for any business. The price to gross margin, when we look at stock price in the next slide, is reasonable. But if you take out the marketing expenses, you can see they have a pretty tremendous amount, about half of their gross margin goes towards marketing expense. So if you take that in half, actually the margin is smaller. Margin is quite smaller because right now they are spending a lot of marketing. Whether it's an investment in the future or whether it's an expense, it's up to you to make your opinion on this. But it is a steep marketing expense. Debt. The company has very little debt. It's an anti-fragile company. There is no doubt about it. This is a very reasonable long-term debt to equity ratio. So I love that it has so few debt. Let's look at dilution. Of course, when the stock went public, lots of dilution, lots of stock options were granted. But ever since, we have had a little dilution quarter after quarter, but the dilution is fairly typical and fairly low. We really want the best employees to be paid in the form of stock-based compensation because that doesn't hurt our cash, right? The main risk is running out of cash and going out of bankrupt. So it's okay. I find this dilution to be okay. Insider ownership is fairly high at 6.6%, and the business is still founder-led. We know that founder-led businesses do much better, and that's a wonderful thing for that business. The last negative, the last point that I see on this that I think is a negative is the revenue per employee. They've hired a lot of employees in 2021, and so the revenue per employee is pretty low at 293,000 per employee. So productivity needs to scale for CrowdStrikes, and I'm sure they will with such high revenue growth. But I typically like to see revenue per employee closer to $1 million. So that is a negative, the revenue per employee metric. But that's a metric that I really like to use to compare my companies. So will it beat the denominator? Will it exceed 15% a year? Well, with a business that grows at 60-ish% a year, it very, very likely will. But look at this. Look at the stock price. This company was doing so well, up to $300 a share, and then it got halved again. So you're buying this company at about the same price, maybe 10% more than you bought it 2 years ago. But, over the past 2 years, the company has grown 60% each year twice. So the company has way more than doubled in terms of revenue. It's a company that's much more than twice as big, and you still pay the same price. So the company is probably the cheapest. It's been it's the cheapest it's ever been, really, if you're investing in this type of company. So I am buying the company. This is not investment advice. I am buying this company as one of my high growth stocks, and I think this company is going to do really, really well in the future. But how does the company stack up with other firms? Well, we can see it's one of the most expensive companies in my favorite metric, which is price divided by post-marketing profits. We can see that it's actually a fairly expensive company. It's out there with Cloudflare and Enphase, which are two other stocks that I like right now. Tesla is actually, and Datadog are actually much cheaper from that standpoint. But the reason why this company, per my favorite metric, may still be a little more expensive than peers, at least peers in terms of high growth companies, is because people see cybersecurity as a sure bet. People don't see a threat, right? Tesla, people may be thinking there's some threats to Tesla, but I think it's a consensus that all investors have, that cybersecurity is going to be the next big thing for the next 10 years, and there's very little risk. It's a defensive stock. If you deal in cybersecurity, that's a very defensive sector. These sectors have not been hurt as much by the current recession. So either way, I think in a portfolio of high growth companies, very fast, 50% growth or more, this is definitely worth a spot in such a portfolio, not investment advice. Let me finish with the trademark of this channel, which is we look at the dilution of the US dollar in this channel, and we can see that $1 today sorry, $1 today is $1 today. $1 in 2027 will be 50 cents in 2027, and $1 in 2032 will be 25 cents. So I expect a huge dilution of the dollar, where 25 cents in 2032 is the equivalent of $1 today. So sorry, it's the opposite, but you get what I mean. There's going to be huge dilution in the US dollar. And so what that means, well, can this company 10x, which is like the big question that we ask? Well, right now, the company is at a 36 billion market cap. If it 10x's, right, that's going to be 360 billion. That's steep. That's probably not something that we would see as possible right now. But is it possible if you take into account the denominator, if you take into account the dilution of the dollar, is it possible? And when you realize that 360 billion in 2032 is more like 90 billion today, then you realize that it's highly possible that in nominal terms, this company will do a 10x in 10 years. At least I have little doubt about it, which is why I am personally investing in it. This is a high growth stock that is likely going to do very well within the next 10 years. Of course, never investment advice, and this will never be investment advice, just entertainment. Thank you so much for watching my video on Crowdstrike. Don't forget to like and subscribe, and I'll see you in the next video. Thank you and have a great day.